As part of the blockchain R&D lab, we have done several projects. Some of the key projects are the blockchain-based agri-fruit traceability, which we did in Australia. Property registrations using blockchain. We had done a small project for government of Andhra Pradesh earlier. Crypto token issuing, initial coins offerings. We have done a ICO which had raised around $10 million. And we also created a unique reward and redemption program for university, wherein we created an app by way of which the faculty can grant coins to students on performing well on various aspects, and those coins can be redeemed as an entry to special events the college conducts. So those were some of the projects. I'll move on. So I think everybody must have heard about blockchain. So I would like to spend 30 seconds hearing if someone wants to tell what is blockchain. So I want to hear at least a couple of people, tell me what they know about blockchain. Just whatever few lines you might be able to say. Anyone wants to attempt? All right. So yeah, so when we talk about blockchain, when we ask people what is blockchain, generally what is blockchain, the definition of blockchain varies from people to people. Blockchain means different things to different people. So what you associate blockchain with, where you have heard about blockchain, depending on that, we have certain perception of what is blockchain. Majority of the people think blockchain is the technology behind the cryptocurrencies such as Bitcoin and Ethereum, which is true. That is where blockchain actually came into existence first. But over the last few years, blockchain has evolved and it has found many use cases across many industries. So it is in fact touted as the next big revolution in data and integrated systems. So we will know more about it as we progress. And also, many a times you might have heard that some company which is doing something in blockchain has attracted some funding. So generally, a startup which is associated with blockchain technology, gets more attention, from VCs and the funding organizations. So it acts as a lucrative buzzword. If some startup is having blockchain as part of their product, they may get more attention than others. Over and above all, blockchain so far has been a technology whose value is not completely visible yet, because it has not proliferated into our day-to-day lives yet. So depending on where you have heard about blockchain, it could mean any of these things for you. So we will delve more upon blockchain as we move along. So what is a blockchain? The simplest way to explain is it is one big ledger in a cloud. So blockchain is a shared, trusted, public ledger of transactions that everyone can inspect, but which no single user controls. It is distributed database that maintains a continuously growing list of transactions, data records, cryptographically secured from tampering and revision. So as record keeping has evolved, previously there used to be manual ledgers like one in this picture here. But again, as technology has evolved, everything has been digitized. However, there was a certain lack of trust between users of information across certain process. For example, all of us have bank accounts. So bank is one central organization which has information pertaining to all the people who hold accounts with them. Whenever we want to make payment to someone, we cannot pay directly to them. We have to go to a bank. In fact, in the uh, olden days, uh, banks used to have people who were called tellers, because they will check the ledger and tell you what is your balance and what are the transactions you are doing. So that means we needed someone to keep a record of all the transactions, and we used to go to them to understand where we stand, what are our transactions, and what is the balance. So that's how these structures like banks were created. So whenever a trade happens between two people, international trade, let's take an example of international trade. I don't know the other party's financial standing. They don't know my financial standing. But there are banks in between, because banks are trusted. They trust, our bank will trust their bank, but we and the other party cannot trust each other. So that is where we needed intermediaries to bring that trust in the whole business process. What blockchain is doing is it's removing the need of such intermediaries in between and making the transactions happen seamlessly without any intermediaries, by having a distributed ledger which is publicly viewable, and a transaction can enter into that ledger only upon a consensus between the people who actually write transactions into that blockchain. So we will talk a little more about it as we progress, but simply said, that is what blockchain does. It is a record of transactions which can be viewed by anyone, which is not owned by someone. Any information going into the blockchain has to be having consensus among all the people who can write transactions on that blockchain. And moreover, all of this is cryptographically secured. So nobody can tamper, revise, or do any kind of change with the data you're putting on the blockchain. I'm sure I'm going at a good pace, but if I'm going really fast, let me know. And if you have any questions, please feel free to raise your hands. All right. So here I'm showing you the same thing what I was talking about. So let's take example of international trade payment. So you might be buying something from, let's say, United States. You need to pay in US dollars. You are billed in US dollars, but you cannot pay US dollars directly to the other party. You have to go to your bank, and your bank will have to go to their US dollar correspondent. And that US dollar correspondent will go to the central bank in America. And through the central bank clearing, they will pay US dollars to the beneficiary bank. So that is how the system works. So there is a need of intermediaries because the process is like that. So, but in case of blockchain, we don't need these intermediaries because the entire ledger is on the cloud, and transactions can be viewed, affected in the ledger in near real time. So you don't need so many intermediaries to keep record of the same information at every point until the transfer happens to the end party. So how does it happens? We will see little more as we progress. So we heard about blockchain, what it is, but what is it useful for? So at the very basic, it is useful for these three main functions. It can store digital records. It gives you unprecedented control of information through secure, auditable, and immutable record of transactions. Second function it can do is exchange of digital assets. By digital assets, it could be something like a cryptocurrency, which is an asset, or some token which actually is backed by some asset in real world. So you could have a record of that asset, and you can exchange that asset by exchanging the token or the currency in digital form. So you can exchange assets from one person to other. And the third and the most important feature is executing smart contracts. So as blockchains evolved, initially they had only recording, then they had exchange of assets. Now they have also added smart contracts, wherein based on predefined business conditions, some contracts will get activated and the transaction will be triggered automatically when so and so conditions are met. So, for example, insurance industry is using smart contracts. So, for example, you are traveling and you have your insurance should pay you for every hour of delay in flight, let's say 1,000 rupees. So their blockchain system can integrate with the system of the airlines and track the time of departure. And if the departure time is above and beyond the scheduled time, it can automatically calculate how much is the delay and process a claim settle to your bank account. So that is how any kind of business logic can be wrote into a smart contract, and nobody needs to do anything. The smart contract gets activated as soon as a certain condition or a set of conditions are met. So that has given a lot more flexibility to organizations to trade, to conduct transactions with their customers or with other organizations. There are multiple things which can be done. You can read more when if you have time, but I will show you some little examples as we progress. Right. So as I told you, blockchain has been evolving. In the generation one, it was only simple ledger that could record transactions, uh, mainly for Bitcoin, because that is where the blockchain actually started for digital currency. And then as it evolved, Ethereum came into picture, which is another cryptocurrency, the second major cryptocurrency. And it brought the concept of smart contracts and logic, which created lot many more possibilities. And now we are having more developments. They are working on improving the transaction speed, interoperability of different blockchains. If multiple organizations have their respective own blockchains, how can the blockchains talk to each other, and how can transactions and business logics of those two different organizations can be triggered to execute a transaction. So a lot of such developments are happening as we speak, and you will see much more possibilities from blockchain in years to come, and probably it will become part of our daily lives as it gets into industries which actually affect our daily lives. So that is how blockchain has evolved. What are the benefits of blockchain? So a couple of benefits I could point out. It is cryptographically secure because all the transactions are cryptographically secured. It is a permanent record and is tamper proof. It is trustworthy because transactions can happen only among, with consensus among the participants. The transactions are faster, obviously, because there are no intermediaries. The transaction can be affected in near real time. Reduced transaction costs because there are less intermediaries. The cost of transaction also is lower. There is greater transparency because by nature the blockchain is distributed ledger, so the information is available freely for people to verify as and when they need to verify that as part of a business process. No central authority, so nobody, one single person or single organization actually controls the blockchain. So that is very important, because otherwise transactions could be manipulated if one person or one organization can control what goes into the blockchain. So that is not the case. It's a network of nodes with different organizations, different people coming together and having a consensus before a transaction can be put into blockchain. no single point of failure. So traditional systems, if they are on one machine or one cloud server, and if that server goes off, the business could get affected. So no such possibility exists in blockchain because it is a distributed ledger. So you have copies of the transactions in every node, which is part of the network. So if one node is down, it's available in all the other nodes. So it could be, taken out from some other node. So there is no single point of failure possible. So those are some of the benefits. Now let us look at a very simple example of how actually blockchain transaction works. So step one would be someone requests a transaction. If let's say I want to pay someone, so I go and I submit request that I want to pay so and so person so and so amount. The transaction request is broadcasted to a P2P network. P2P means peer-to-peer network, because blockchain consists of many nodes which have equal importance. Nobody is like having higher importance or lower importance, and all of these nodes have to come to consensus before a transaction can be recorded. So it is called peer-to-peer network. So the transaction is broadcasted to all the nodes. So the network validates the transaction and the status using some algorithms. That is where the cryptography and the algorithms come into picture. Once the transaction is verified, for example, I want to pay you 1,000 rupees. So the network, the transaction is broadcasted. So the network has to make sure that my account has those 1,000 rupees, what I'm talking about. So if those 1,000 rupees exist in all the nodes for my account, that means my request can be processed because I have the money to make this transaction happen. So I'm just giving you one simple example. So likewise, there could be many other conditions which the network can verify. And once it is verified, the transaction is recorded, and the ownership of a particular asset, in this case money, or it could be coins. So if I'm paying, let's say 10 bitcoins to someone, so 10 bitcoins in my wallet will be transferred to the wallet of the person to whom I'm paying, and the transaction is affected and broadcasted to the network immediately. So me sitting here can see the transaction happening in real time, or near real time, we can say. So once the transaction is verified, it's combined with other transactions to create a new block of data ledger. So as the name suggests, blockchain consists of blocks of information. Each block is a set of transactions blocked together. So depending on the kind of blockchain we are using, the block can be formed based on some certain logic. Like for example, every 250 transaction is one block. If my blockchain is written in such a manner, the code is written in such a manner, so every 250 transactions will be blocked together and they will be placed as a block. So as every 250 transactions complete, a block is created and it is added to the existing blocks. So that's how a chain of blocks is created, and that is how it is called. That is why it is called blockchain. If I have to explain you it in a bit more simpler way, each transaction is happening, it is put into a block. So all these blocked transaction, when a certain limit is reached, the block is created. I mean, it is uh, finalized, and it is added to the chain of blocks which you have. So when you add it, you are connecting it with the previous block, and once the new block comes, that is also connected with this block. So you are connecting the blocks. It's a chain of blocks which progresses as new blocks are added. The chain gets longer and longer and long. So each block is added to the next in an irreversible chain. So when I add the existing block, all the information from the first block, which is called the genesis block, to the current block, all of that is cryptographically secured and cannot be changed. If I have to change one transaction anywhere else in the whole blockchain, I need to affect change from the Genesis blockchain block to my current block, which is why it makes making any change in blockchain almost impossible, because there are millions of transactions. So if you want to affect one change, then everything has to be, every block has to be made that change, so that the information is seamless across the blocks. So that is called uh, basically network of blocks which are cryptographically secured. So what happens is, if there are 250 transactions in a block, each transaction is converted into something called hash, and the combined hash, the all the 250 transactions together, their hashes together, is created as an overall hash. So every transaction has a hash, every block has a hash, and if any information has to change in any of the blocks or any of the transaction, the entire hashing has to be done again. So you have to change the hash of the transaction you are changing will change, which means the hash of the block will change, which means the hash of entire chain of blocks has to change. That is what is the beauty of blockchain system. Any change someone wants to do, it is difficult. I will not say it is impossible, but it is very difficult, and that is why it is secure. Different types of blockchain. So there are different types of blockchain based on the needs. Broader classification is a public blockchain or a private or permissioned, it is called blockchain. So a private blockchain is where one particular organization or a group of organizations own a blockchain, and they can decide who can have access to that blockchain. So they will permit only limited number of users to join the blockchain, and there will be a centralized authority who will allocate responsibility to individuals as to what operations they can perform on blockchain. It could be centralized authority, or it could be a group of people who have to come to consensus and approve for a person to join the blockchain and do certain transactions on the blockchain. And in this case, because it is a private blockchain and the participants get access only by prior authorization, the identity of the participants is known to the network. Vis-a-vis a public blockchain where anybody can join and participate in the network. The real example of that is Bitcoin or Ethereum. You don't need to have permission from anyone. As long as you create a wallet on Ethereum network or Bitcoin network, you are a participant in that network, and you can record transactions, you can make transactions on blockchain as you want. What the key difference is, in public blockchain, your identity is not known to the network because it is a distributed ledger which is available to everyone. So your wallet address is your identity. Like for example, everybody uses email. So if I see someone's email, I cannot recognize whose email is that unless the email is actually actual name of that person. So which is true in some cases, but in majority of the cases, the email will be different from your name, little bit different. So while you are in the email network, everybody identifies you with your email ID. That is your private public key. In blockchain, it is called public key, which is your identity on the blockchain, which is your wallet address. So that wallet address is your identity, and you are known in the network by that wallet address. Anybody who wants to do any transactions with you, they will do the transactions with that wallet address. So if I have to send email to someone, I will send email to a particular email ID. I may or may not know the person. I may or may not know that email ID belongs to a particular person, but I'm able to send email to that email ID, and you will receive email when I send email to that email ID. In a similar way, I'm just trying to give you common examples which we use. to make you understand how it works basically. So once you create a wallet on a particular blockchain network, that becomes your identity, and the transaction is between wallets. Nobody would know if you or someone else holds that wallet. So that's how a public blockchain functions. We will move forward. All right. So we have talked quite a bit about blockchain, but how do we really know whether an organization or a business process really requires a blockchain? So there are multiple, ways of doing that. I am just discussing here a simplified version of decision tree. So if your answer to these questions is yes, that means you can implement blockchain for that particular business use case. Is there a need for a shared common database? So if you have large number of participants in a particular business process, that means you have people who have to access one set of it. So that means you need a shared database which can be used to access information each participant in the business process needs to have to perform their role. So if there is a need for that kind of a common database, then you can implement blockchain. Are multiple parties involved? As I said, if there are multiple parties, it makes much more sense. Do the parties involved have conflicting incentives and or mistrust each other? So again, there could be multiple parties. So each one of them will have their own interest. For example, if we are talking about supply chain, the supplier has their own interests, the buyer has their own interest, the transporter has their own interest. So everybody, like for example, if some mishap happens, if materials gets lost or material is not what it has to be, so that particular incident affects different parties in different way. And in the event of lack of information which can be verified from a trusted source, everybody will have their own version of the incident because they are trying to protect their own interests. So their interests often are conflicting. So if you have a situation like that, blockchain is the most suitable tool for you. Are there differences in the rules that govern these parties? So there could be multiple parties, their interests are different, and the rules with which these parties are governed, transactions of these parties are governed, are different. So what a buyer wants to do, what a seller wants to do, or what a transporter wants to do, or what the regulator wants to do in case the goods come under some regulation. So how they operate, how they see a particular transaction is completely different. The rules which govern these transactions for them is completely different. If that is how your industry or a business process is, then blockchain is suitable for you. Is there a need for an objective, unchangeable log of records? So the major problem in any business process is there is no unchangeable log of records. If there is an unchangeable log of records, information can be verified from that source, because as information, as events happen, and if they are recorded in this log of records, nobody can go back and change or manipulate it, and that will act as a source of truth. If your business process needs such a source of truth, then blockchain is useful for you. Do the rules behind that transactions rarely change? Again, it is also very important that your industry does not have change of these rules quite often. If the rules are pretty much rarely changed, then the blockchain works beautifully, because blockchain once built, it is very difficult to change it. You will have to create another blockchain if you have to change any rules, because once it is implemented, nobody can do the change. That is the very nature of blockchain. So if your rules change very often, then blockchain may not be the right option for you. But if your rules rarely change, then blockchain will work beautifully for you. So if trust within the network and data security is important, then blockchain it is. I hope everybody is following, and I'm not going too fast on this. I just wanted to confirm. All right. Uh, these are the, so maybe you got, you did this, sorry, you did this assessment and you understood that blockchain is actually suitable for your business or process. What do you do next? How do you actually implement blockchain? So there are certain steps which you can follow to, you know, implement blockchain. So typically these are the steps. Number one is to strategize what kind of challenges and opportunities you have in your business and how blockchain can be applied to that particular business challenge or an opportunity which can be made possible using blockchain. Then what you do is next is, once you have zeroed on some business challenge or opportunity, you create a proof of concept. That means you do a controlled learning of how that use case works with blockchain. So you make a proof of concept, you make a pilot system, and you let it work, and you observe how it works and whether it is giving you the desired results what you are looking for. And then you scale. Sorry, I think I went wrong. So you strategize, you develop a plan, and then you do a proof of concept. Then you create the pilot and you scale. So you might have done with one business process, you will scale it to other business processes, a set of business processes, or in some cases, it could be organization wide business processes. So you evolve slowly from one process, make it success, move on to few more processes, move on to a set of few more processes, and likewise you will take an incremental approach in uh, applying blockchain and getting benefits of blockchain technology in your business. So what are the key success factors? You know you need the blockchain, you have the strategy, you are doing all those steps and trying to implement blockchain. But from the blockchain implementations we have seen in the industry so far, the key success factors would be thorough feasibility study of the opportunity assessment. So if you are taking up a business opportunity or a business challenge you want to use blockchain for, you need to do a thorough feasibility study of whether with blockchain that process can give you the value addition you are looking for. Second most important thing is selection of right technology and platform partner. So there are various blockchain platforms. There are different types of blockchains, different types of technologies within blockchain. So you need to use the right platform and you need to have the right partner who can help you build a blockchain which will give you the desired benefits you have been aspiring to do. Cross-functional and collaborative development approach. So blockchain technology, when you apply it to any business process, you cannot apply to it unless you have all the functions involved and get affected by such a process, forming a cross-functional team, and they are part of the strategy, the feasibility study, and the uh, other steps like the POC and the pilot until the product becomes functional. So because every function, every department will have a different effect of what and how they do things in the normal way of life. So if you have a cross-functional team, everybody will have their own view, and they will be able to you will be able to build a product which meets the expectations of all the parties involved in the business process. And the last important factor is comprehensive integration of systems and processes. So in many cases, blockchain doesn't replace existing systems. It augments your existing systems and gives it that additional advantage of distributed ledger. So what you do in many cases is you integrate your business systems into blockchain and use blockchain as a single source of truth as and when it comes to verifying a particular bit of information. So the integration of your systems with blockchain, how efficient it is, that will determine how successful your blockchain implementation could be. So some of those are the success factors when you implement blockchain. What industry is looking for? So we have heard a lot about blockchain, how it works, all that, but what they are looking for is strong governance, wherein you have certain rules within the network, and the network governs itself. Nobody can manipulate or do anything which can compromise the governance process. Data control. Obviously, blockchain gives you unprecedented control of data because the very nature of blockchain is that it is a peer-to-peer network, and it has cryptographically secured storage of data. Compliance with regulatory requirements. In some cases, you have regulatory requirements in some industries like banks, insurance, or agriculture, or whatever it is, whatever name the use case. So you need a single source of truth to be available to comply with these regulatory requirements, and blockchain gives you just that. Standardization. So as I told you, there are different technologies, there are different types of blockchains, but a certain standardized uh, you know ways of implementing blockchain has evolved over a period. So the more standard it is, the better it is for industry to adopt. Identity framework. So blockchain based identity. So for every transaction on the blockchain is recorded, and the identity of the people who are doing these transactions is on the blockchain. So you have an identity framework on the blockchain itself. So that is what is another important thing industry looks for. Security and cyber defense. Obviously, one major benefit of blockchain is data security, and it certainly gives you uh, unmatched security. Reliability. So it gives you unmatched reliability because, as I said, there is no single point of failure, and there is no tampering or doing anything with the blockchain, which you can do with traditional systems. So reliability is much more. Scalability is where things are still evolving. Right now, because of the very nature of the way blockchain works, the transactions per second, it is called, the speed of the with which the blockchain can process transactions is quite low at the moment, but there are rapid technological developments happening, and we might see the TPS improve substantially as we see more some of these blockchain technologies evolve to their next stage. Some of the industries which can use blockchain. So there are numerous examples. There are examples in education, banking and financial, healthcare, gaming, video streaming, pharma, government and public records, energy management, and obviously supply chain and logistics. So there are n number of cases because every industry has processes which have lot of participants, and there is need of a one single source of truth which is immutable and which can be used to to bring trust and transparency within the business party system and the participants, among the participants. So within supply chain also, I have just mentioned a few items like commodity trading, auctions, counterfeit goods, how do you detect counterfeit goods, luxury items, asset transfers, agri authentication, shipping and logistics, supply chain financing. I will be talking about supply chain financing and some of these items as we move along. Yeah, but any process which has multiple participants and which can use a distributed ledger to reduce duplication of effort at every point by having a centralized single source of truth, blockchain can help any of the those processes. So I will briefly delve into two processes just to show you how blockchain can transform an existing process. So here I'm showing you purchase to pay. It is called P2P in general in finance parlance. So in purchase to pay, you have multiple parties involved, and there are multiple interactions happening between those two parties, as you can see. So there could be a supplier and a client between whom the transaction is happening. But when the transaction happens, there are many steps, like the client raises a PO, the supplier acknowledges it, then the supplier sends goods and a goods receipt note with it. The client receives the goods and acknowledges that the goods are received. The supplier sends the client an invoice. The client verifies and pays. But again, for payment, the client has to go to their bank has to go to the supplier's bank, and then the money finally reaches supplier. And if you extend it a little more further, when auditing happens, there are at least 4 auditors will be required. The supplier will have their own auditor, the client will have their own auditor, both the banks will have their respective auditors. So as you can see, there are multiple parties involved, there are multiple steps involved, and all of them are verifying the same information at their respective ends. So if they have one single source of truth, they can avoid duplication of effort at all of these individual places. So some of the key things which we can see is there are about 20 processes and steps to be followed. They have to be reconciled. Goods returned processing becomes even more painful because all of this has happened, and then it has to negate or change one or more of these things. So there are multiple follow-ups required. It is the whole system is prone to errors. Data in supplier and the buyer system are not mapped. Supplier might be showing some data, whereas buyer might be showing some other data. And there are a number of steps and auditors who are duplicating effort at each of these participants. So supplier's auditor is auditing the same transaction, client's auditor is auditing the same transaction, and likewise banks are also, their auditors are also auditing the same transaction. So you see there is so much of inefficiency in the whole process. But with blockchain in picture, they don't have to keep the siloed information with at each participant, and they have a centralized blockchain source of truth which acts as a source of truth for all the parties. So all the documents from purchase to uh, you know finally the payment can be stored in a centralized blockchain based system, and it is accessible to all the parties to verify the part of the information they need to process the transaction at their end, or process the transaction or a step in the transaction at their end. And Obviously, because all of them are looking into same single source of truth, the possibilities of errors are very many, almost zero, and there is trust because the transactions put on the blockchain cannot be manipulated by one single party. The transactions have to have consensus across the parties, and then only they can be put on the blockchain. And at any given point of time, blockchain acts as a single source of truth for anyone to verify and move forward with their part of the process. So that is how uh, blockchain is revolutionizing the way traditional functions used to happen and how they happen with blockchain coming into picture. We will see one more example, and this one is maybe related to supply chain and logistics, ports and trades. Uh, you know, what is the current situation? There are about 30 participants in the whole process. There is a supplier, there is a local transporter, freight forwarding agents, international carriers, shipping companies. Then there are customs department, there are port authority, clearing agents, warehouses, local transporters, and finally customer. So as you can see, I mean, I have just highlighted some participants, but there are directly or indirectly more participants who come into picture to complete a particular, you know, transaction when it has to go through international trade. So there are multiple documents involved, like the goods shipping note, supplier license, packing list, insurance, quality certificates, invoice, letter of credit, purchase order copy, certificate of origin, all of that. And the same documents are to be verified multiple times, and often there are mistakes across these documents, and goods are stuck, which costs money to one or more of the participants in the whole chain. So as of now, most of this is semi-digital, but most often it is paper-based because documents are to be required to be submitted for clearing from one step to other. There are middle parties, agents, and the whole process is fraught with, you know, possibilities of errors. And any error could cause delay, disputes. It is time consuming, and it even costs money because every transaction failing, it has to go back to its source, and there is a lot of cost involved. So how blockchain can revolutionize this whole process? Let's see. So with blockchain, all of these participants can come on to one particular blockchain. There is a common set of documents, digitized, verified, and put on the blockchain with digital signatures, or what I call the identity of the person, digital identity of the person on the network. And you can even have smart contracts, which could work automatically based on certain conditions being met. It is secure, immutable, and you need consensus among the participants to put a transaction onto the blockchain. So that is how, you know, instead of having so much confusion, having the same information verified again and again at different steps from different sources, you have one single source of truth, and the transaction efficiency can be improved significantly. So that is the port and trade example. Let me also talk about supply chain finance, which is an emerging uh, process which is happening in the supply chain uh, in the industry. So in fact, I was personally involved in one such small POC we did for supply chain finance. So what happens is there are big manufacturers who have uh, billions or trillions of dollars of business every year. But however, they don't manufacture everything by themselves. There are suppliers who will supply them most of the material they sell, and there are sub suppliers who supply components which go into the product which the supplier supplies to the manufacturer. That is at the supply end. On the distribution end, on the other end, there are distributors and there are retailers. So many parties involved. Now, a manufacturer, like for example, if you take a big name, like let's take a name of, let's say, Apple. Apple manufactures smartphones. It sells smartphones, but it doesn't manufacture everything by itself. It has suppliers who build majority of the phone and send them, and they assemble and sell it to various markets. And the suppliers who are supplying them phones, there are more than thousands of components which go into the phone, and the supplier is not making all those components themselves. They are in turn getting it from a sub supplier. Likewise, Apple doesn't sell everything by themselves. They have distributors, they have country distributors, and then regional distributors, and they have retailers. So a major phenomenon what we see is Apple being a big company, their cost of capital is much lower than the cost of capital of the participants with whom it works. I am taking a hypothetical example here. The manufacturer's cost of capital is 4 to 5%, depending on which country they are in and all that. Whereas the supplier who is supplying to them, their cost of capital is 10%, because they don't have the kind of standing a big manufacturing company will have. Whereas the sub-suppliers who supply components to the supplier, they are generally small companies, small and medium enterprises, and their cost of capital is even higher, as high as 20%. Same is the case on the distribution side. The distributor's cost of capital could be 7%, but the retailer's cost of capital is much more. Because of their small size, they have to pay more to get capital from the market. So what supply chain finance does is the manufacturer, when the supplier invoices manufacturer, the manufacturer can finance that invoice by involving a bank. And when they finance that invoice, they get the finance at the cost they have to incur if they have to get finance, and they pass on that benefit to their supplier. So the supplier might not have the standing of a manufacturer, but their invoice, if it is financed by the manufacturer, will be financed at a much lower cost than they themselves can go and get it financed in the market. So likewise, participants with different cost of capital can take advantage of one big entity getting invoices or bills financed on their behalf, and this has become a revenue model for the manufacturer themselves, because they are able to finance these things at a cheaper cost. They can actually charge some sort of service fee or premium over the cost they incur when they finance it for them. So it has become a significant source of revenue for big companies. It also helps them to keep their supply chain reliable, and have good relationship with their supply chain participants, as they are working to make the costs of capital lower for them, so they are able to take more finance, and they are able to supply faster and more quantity to them. So that is one more thing which we are seeing of late picking up. I think that's all I have today to share. Thank you very much for listening to me patiently.